Welcome to episode 82 of Live with the Maverick. My name is Dominic Lee, founder of Maverick Actuary. We are a content community. Our mission is to maximize the impact and value of quant professionals on a global scale. The goal of this series is to educate our community on the most relevant themes in actuarial science, risk management, and analytics. The theme of today's discussion is enterprise risk management. And we are very excited to have with us our guest, Paul Sweeting. Paul is a senior advisor at Hassana Investment Company, the investment manager of the General Organization for Social Insurance in Saudi Arabia. Paul is an honorary professor at the University of Kent and also the author of Financial Enterprise Risk Management, one of the source texts for IFOA exam SP9. So welcome, Paul.
Good to be here.
And I should say a returning champion. So this is Paul's second episode. Yeah, so good to see you as always, Paul. So just love to give you a chance to introduce yourself.
Well, I think you did a pretty good job there. I mean, there's not an awful lot to add. I've been working in the actuarial profession now for, more than 30 years. Started in pensions, moved into investment consulting, then asset management. Spent a little bit of time in longevity reinsurance, and also in academia as professor of actuarial science, and then into ERM in the investment world and social security when I was at 𝗘𝗽𝗂𝗲𝗪. So most things apart from general insurance and health, but there's still a few years yet, so who knows?
Okay. Yeah, so I mentioned I've been excited, not just to talk to you, but in general, been very excited for this episode because you're, I consider you to be one of the premier thought leaders on ERM, globally, and you've obviously written the textbook which many actuarial students rely on. So, very excited to get into this topic. So, a very broad question. So, how would you, as someone who's an expert on this issue, for you, what is enterprise risk management?
For me, enterprise risk management is a 600-page textbook, and that's just financial enterprise risk management. The shortest and potentially least helpful definition of enterprise risk management is the management of risk within an enterprise. So it sounds slightly simplistic, but that's really what it is. It's looking at risk across an organization as a whole rather than in individual silos. And what that really means is it's not just enough to analyze each individual risk. You've got to look at how they all fit together, which is why a lot of the mathematical techniques around ERM, around those kind of linkages, around how you can connect the different risks in a consistent and a helpful way. And there's other aspects to ERM as well. It usually implies some sort of process as well. So some way of systematically identifying all of the risks, quantifying them individually and together, then working out what you're going to do with those risks, taking a decision, and then actually implementing any risk mitigation techniques, and then going back to the beginning and doing it all again.
So when we talk about the risks, of course, an insurance company, it's not just limited to insurance companies, but for instance, like what are some of the most common risks that you're going to see, like with an insurance company as an example?
So if you're looking at an insurance company or any kind of financial institution, there's a few kind of categories of risk that you've got. I guess you could put them into three different buckets. The first is the investment risk, because most financial institutions have a big pot of investments that they need to generate returns from to a greater or lesser extent. The second is operational risk. So that's just the nuts and bolts of getting stuff done and making sure that systems and processes work and managing the risks around people and so on. Mm-hmm. And then the third category is that group of risks specific to the industry that you're looking at. So if you're looking at a bank, then it would be things like credit risk, because what banks generally do, traditional banks, is they tend to take deposits from people with bank accounts and then lend it out to people. That's fundamentally what banking is. For insurance, you're looking at the risks in relation to underwriting. So are you selecting the right risks? What range of risks are those policyholders then facing? And will you have enough money to pay those risks off? So those kind of three broad buckets.
When it comes to insurance, one really common ERM application I've seen, certainly in practice, and I'm curious to get your thoughts on, is capital modeling. So how would you describe capital modeling?
I'm not an expert on capital modeling, but it's basically around making sure that under a range of scenarios, you've got enough capital in the firm to cover the risks that the business is running. So it's a way of looking at what your investments are, looking at what your assets are, looking at what your claims are likely to be, and projecting those forward under a range of scenarios, and making sure that you are sufficiently likely to have enough capital to meet those, or making sure that the capital you've got is going to be adequate to cover your expected outgoings under a sufficient proportion of scenarios.
Got it. Now, a natural question, we have a lot of actuaries who are going to be watching this, is how do actuaries add value in the ERM space?
I think the key area, I mean, I said at the start that it's about managing the risk for an enterprise as a whole. So you're trying to look at how everything joins together. But I think it's quite difficult to do that if you don't understand what is actually going on in the different risk buckets. It's quite difficult to look at the contribution of the various insurance-related risks to the total risk if you don't understand how those insurance risks work, I think. I mean, you can do it, but then you're taking a lot on trust. So I think where actuaries can help is, on the theory side, is they have a good understanding of the underlying risks that affect a lot of these financial institutions, particularly insurance companies, but increasingly in banking, which is an area that more actuaries are moving into overseas, if not in the UK. So I think that's one area. But I also think that the actuarial training is quite helpful in an area like enterprise risk management, where there's a lot of discretion and professional judgment, and does this look right type tests around it. And I think the actuarial training is quite good for helping people make those kind of decisions, to look at a set of results and say at the end of it, does this look right? Is there something missing? Do I believe this? And that kind of goes beyond the technical skills into the more professional skills that I think are an important part of what makes an actuary an actuary.
Okay. So one of the things you said, which I think is really important when we talk about ERM, is that it's a complete risk management framework. So you're pulling together all of the risks of the organizations. You're not just looking at it in a vacuum. You have to look at things together. And, we previously spoken about putting a distribution around outcomes to understand, how uncertain things can be, which I think is really important. And modeling, not just modeling distributions, but how they link together and correlate. So that takes us, when we're looking at all of these different risks together, that takes us into the multivariate realm. And when we think of the multivariate realm, for anyone who's studied actuarial science or gotten, done fellowship exams, so copulas come to mind. And I know this is a topic that appears to be, on the outside at least, near and dear to your heart. And I've recently seen you made several YouTube videos about this topic. So, for the benefit of the audience, what is a copula?
So we said enterprise risk management was about 600 pages of a book. I think the copula is one fairly large chunk of one of the chapters in it. But a copula is, there's several ways of thinking about what a copula is. If you think about different risks, different distributions, and you think about how they move together, the way you'd normally think about that is, what's the correlation between them? But the correlation is just a number, a single number trying to describe the whole relationship. And what a copular function does is it helps you understand the shape of that relationship. So it doesn't just tell you what the overall relationship is in terms of correlation. It tells you whether the two distributions, or how many distributions you're looking at, move more closely together when everything's in the bottom left corner, so you've got lots of negative results, or in the top right corner. So it tells about sort of the joint fatness of tails. So it can be very useful if you need a bit more detail than just the correlation. And you do sometimes. If it's not properly allowed for, you can get some really big problems. And the best example of that is, and possibly the most famous example, is in the financial crisis, the global financial crisis, which it's hard to believe it's around sort of 16 years ago now. But that was driven to a large extent by credit derivatives, mortgage derivatives. And the way that they worked was you took a package of, say, mortgages, of loans, and you bundled them all together, and then you sliced it up and you said, okay, if there are no defaults at all, then this particular tranche gets all its money back. And any defaults eat into that tranche only. And only when that tranche is exhausted do you get onto the next tranche, and so on and so forth. So you've got different risk sleeves in these investments. And when you try to work out, well, what should the attachment points be? What should the cutoffs be between these different tranches? You need to model how these credits move together. And this was done using copulars. But it was done using something called a Gaussian copula. What a Gaussian copula does is it basically says, when I'm looking at the relationship between these different variables, I'm kind of assuming that if all these variables had a normal distribution, then I can model a whole lot just using a multivariate normal distribution. And one of the side effects of that is that it doesn't assume that you've got any fat tails. It doesn't assume any greater risks of things going jointly wrong with much greater likelihood than things just, the way things just normally move around. And because of this, it underestimates the risk for many of the investors. If you'd used a fat-tailed copula, something like a 𝗘-copula, for example, which has higher risks of things going wrong jointly, so jointly fat tails, in the same way the T distribution has fat tails compared to a normal distribution, 𝗘-copula has jointly fat tails. Use something like that, it would have given you a different answer. So it's quite useful if you're not just relying on, or you don't want to just rely on the overall correlation, but you're really interested in what's happening in the tails of the distribution.
So just to take a quick step back, just to kind of break it down a bit. When I think of multivariate distributions, we think of the multivariate normal. So would it be fair to say that there's some simplifying assumptions there on, you being able to, you need to have the mean, the standard deviation, the correlation coefficient, you need to assume that they're normally distributed, and only under certain assumptions, then, you can use a multivariate distribution, whereas a copula is a little bit more flexible. Would you say that it kind of removes some of the restrictions?
You can use any distribution or any copula you want with any data set.
Right.
It might not be the best one. It might be wrong. It might not be well founded, but you can use anything with anything. Now, I guess the thing about a copula is, if you've got a multivariate normal distribution and you've got some data, you can fit a multivariate normal distribution to the data. But is it the right thing to do? Well, in many cases, you haven't got an awful lot of data. Yeah, it probably is. It's going to give you not stupid results. But you can think of a multivariate normal distribution, or the simplest version, a bivariate normal distribution, where you just got two variables, as really consisting of three separate things. You've got the univariate distribution, the marginal distribution for the first variable. You've got the marginal distribution for the second variable, and then you've got the thing in the middle that joins them together. And the thing in the middle that joins them together is a normal or a Gaussian copula. And what it really is if you take, say, variable A, which you think's got a normal distribution, and you say, well, actually, I don't really care what distribution it's got. what I want to do is I want to strip that distribution out and just have the order of the observations. So essentially, I want to convert that marginal distribution to a uniform distribution. So it doesn't matter if it's normal, it's gamma, it's whatever. Strip that away. All I've got left is the order of the distributions in a uniform distribution. I do that for the other one as well. And then those two become the input for your copula. And if it's a Gaussian copula, what you do is you take the order of those distributions and you say, okay, well, I'm actually now going to change it back to being a normal distribution, but a proper normal distribution. One which is not just one which looks like it might be normal, one where each of those inputs is going to sit on the exactly right part of the normal marginal distribution and use that to model the Gaussian copula. I have to say, this is much easier to explain when I've got a whiteboard and my admittedly terrible drawing on the back of it, trying to draw in 3 dimensions. But hopefully you get the kind of broad picture. And if you don't, as you say, there are some YouTube videos which do hopefully do a better job of explaining this.
Great. No, you partially, I think you partially answered this, but I'll just kind of maybe recite what I heard in terms of why copulas are used for ERM is essentially to kind of measure the dependence between a couple of different variables and how things can move together and what those impacts could be. Would that be a fair assessment? Is there anything else, any other fundamental reasons?
The key reason is that you think that the way in which the variables might be joined together is different from what you'd have implied by multivariate distribution. So you might want to have quite different marginal distributions for the different variables that you're looking at. And you don't want that to define what's happening to the way they're joined together. So you could have one variable with a gamma distribution, one with a t distribution, and you join them with a normal distribution. Or you could have 2 variables with gamma distributions, and you join them with a t copula. So it's trying to separate what's happening for each individual variable in terms of its distribution, and not letting that determine how you explain the relationship between them.
Whereas with the multivariate, you're saying that that's always assuming the marginal distributions are the same.
Yeah, so I mean, you could use, so you can have, as you say, a bivariate or a multivariate normal distribution.
Yeah.
You could have a multivariate t distribution as well,
Right.
where, you know, if you've got, say, a multivariate t distribution with 4 degrees of freedom, that's saying that all your variables have got 4 degrees of freedom in the marginal distributions, and they're joined by a copula which has 4 degrees of freedom. So you're really tying down the options in terms of how much you can really deviate from that. So a copula allows you to say, well, let's look at these marginal distributions separately and give them whatever the best fit is, and then join them with a copula which has the best fit.
Yeah. So thank you, by the way, for that example of the financial crisis. And I want to revisit that a little bit later down in a bit more detail. Sure. But, you know, I think you kind of teed up the practicality of copulas and how they've been used. But you know, now that we have a more fundamental understanding of what a copula is, let's explore the practical side in further detail. So, what are some specific risk modeling applications of copulas in ERM?
So the key one's on the investment side, and the reason for that is when you're using copulas. If you're fitting a copula, the key reason you want to fit a copula is because of what's happening in the joint tails of the distribution. Now, if you think about how much data you have in the joint tails of a distribution, it gets vanishingly smaller the more asset classes that you have, or the more variables that you have. So if you think about, say, 100 observations, if you've got 100 observations and you're just looking at one asset class, then you'd expect to find about 10% of them in the bottom 10% of the distribution, because that's the way it works. If you've got 2 asset classes, you want to look in the bottom 10% of both distributions, well, you're probably only going to have about 1 observation in there. So as the number of asset classes grow, the number of observations you see in those joint tails shrinks very, very quickly. It's called the curse of dimensionality. So as the number of dimensions increases, it gets harder and harder to fit something jointly. Now, investment returns is one of the only areas where you've got enough information on the different asset classes that you can reasonably comfortably fit a copula, which is going to be, and the choice of copula is going to be driven really by what's happening in the tail of that distribution.
Okay. So investments, so from an investment perspective, so you're looking at the performance. You're saying that if you have like a portfolio of, say, simple example, bonds and stocks, you're kind of using the copulas to look at, is it the risk of the returns, like maybe not getting to a certain point? Like how do you think that through?
Yeah, so I mean, a good example would be if you're looking at several different equity markets. So it might be that, you know, if we take it out of sort of popular language and we put it into more sort of layman's terms, it might be that you've got a few asset classes and the correlation between them when things are just bobbling along as normal is about 60%, 70%. But when something happens in global markets and you have a negative shock, suddenly the correlation goes up to 90%. Now, if you've just modeled everything based on the average correlation of, say, 75%, then your assessment of the risk of loss on that portfolio in extreme circumstances is probably going to be on the low side because you're not allowing for the fact that when things go wrong, they go wrong for everything. And that kind of chimes with what we know is that, you know, markets these days are often pretty generally correlated. But if you get something like the financial crisis, if you get something like COVID lockdowns, if you get something like even the 1929 stock market crash, something like that, everything goes down and correlations suddenly head towards one. So that's why it's particularly important for modeling those types of asset classes. And groups of equities is probably where it is closest. I mean, you get a slightly different thing when you're looking at equities and bonds because there are situations in many historical scenarios, you've tended to see negative correlations between equities and bonds. But then sometimes they end up moving together. And you end up in those sort of horrible situations where suddenly the correlation has turned positive and you're losing money on bonds whilst losing money on equities. So copulars can potentially help there as well because they'll give you an idea, a different way of modeling the shape of that relationship.
There are three compelling examples in addition to that one on investments for different instruments that you mentioned, which I think are really interesting. So I'm going to list them. Let's go through these three. If you could just tell us a little bit about what you've seen in practice with these three, and kind of what some of some copulas that you've seen used for these situations. So the three are: the first one is the potential losses, but for different lines of business. The second one is premiums and receivables, and then the third one is insurance and investment risks.
Yeah, it feels like an exam question, really. I'd say that for the first couple, if I was going to use a copula for those at all, and I wouldn't necessarily, because you need to have enough data to fit a copula to it. Okay, so have you got enough data history to fit a copula to that sort of stuff? If you have, you'd be hard pressed to use much beyond an Archimedean copula, I think, which is a really it sounds complicated, but it's actually a really simple copula to use, which doesn't really need that much in the way of assumptions. And you can have Archimedean copulas which have lower tail dependence and no upper tail dependence, ones that have upper tail dependence and no lower tail dependence, or ones that have both upper and lower tail dependence. And tail dependence essentially means things tend to go wrong together. Okay, so normal copula has no tail dependence. A T copula has upper and lower tail dependence. It's got jointly fat tails. So you could use one of those. And they're pretty simple things because what you essentially do is you take the distribution function, or the probability of losses being beyond a certain level for each of your different lines. And that's something which is going to be between 0 and 1. And then you apply what's called a generator function. And that turns your number which goes from 0 to 1 to a number which goes from 0 to infinity. You add them all up, and then you apply an inverse generator function, and you get, again, something which is between 0 and 1, a probability. And that generator function is parameterized by a rank correlation measure. So again, if I had a whiteboard, it'd be much easier to explain what's going on. But I mean, the process is pretty straightforward and doesn't take that much in the way of assumptions. All it really takes is you know, what am I most concerned about? Is it joint losses? I probably want something which has got lower tail dependence. What's my rank correlation coefficient? Yeah, usually sort of Kendall's tau, probably the one you take, or maybe Spearman's rho. That usually plugs into the formula, and then you just crank the handle on a generator function and get a probability out of it.
Yeah.
So that'd probably be the one I'd use the first couple. If I was looking at insurance and investment risks, again, I might use the same thing there because just because of the paucity of data. But I mean, there's no shame in saying I just don't have enough information to apply a copula. It would be spurious, and there is a big risk there that if you're using clever financial techniques, it perhaps makes the results look a little more certain than they are. So I mean, what you might want to do is just say, in this case, I think they might be independent. I'll just take my two numbers, square them, add them together, and take the square root. And that gives me my overall risk. Or you might think, I think there's a risk they might be positively correlated, maybe 50%. Check it in and just do nothing more than something similar with a correlation thrown in. And it is one of the things that given I'm working on a third edition of my book at the moment, I probably shouldn't be saying this, but it does worry me that sometimes people are inclined to overuse copulars and are inclined to place too much faith in the results of analysis because there's a copular attached. Because sometimes I think there's a risk that, you do this complicated stuff and people think, oh, that's really complicated. It must be right. So, well, maybe it shouldn't have been such a complicated approach used.
Mm-hmm. And then you mentioned for the premium and receivables, you'd probably do something similar with the losses. Is that what you're saying, or?
Yeah, absolutely. I mean, because if you think about whenever you've got data, you've got a trade-off between the volume of data and the relevance of the data. Now, if you look at investment returns, daily data is probably a bit too much, but weekly data is usually pretty good. And you can looking at weekly data across the world, it's going to be reasonably consistent. Monthly data, certainly. If you're looking at things like premiums and receivables, how frequently are you going to be able to get that data? Mm-hmm. And if it's not that frequent, if you go back for the same firm, say 20, 30 years with that data, how relevant is 20, 30 year data for a particular firm going to be to the modeling now? So there's a good argument to say that when you're looking at financial markets, there's really nothing new under the sun. And the way that they move together is, it's been the same for a very long time. I mean, if you look at things like, say, the dot-com crisis, the back end of around the turn of the century, what you had was an awful lot of companies of which many were overvalued, not making any profit, and crashed and lost a lot of money. If you go back to the 19th century in the UK and look at railroad stocks, you had there a lot of companies, many of which were making no money, many of which crashed. Now, railways and internet startups are quite different, but the way markets viewed them and reacted to them was actually pretty similar. So, using a long time horizon for investment returns is probably not daft. But if you're just looking at what's happened within an individual firm in terms of things like premiums, receivables, and so on, trying to draw conclusions on what happened in those variables over a 20, 30 time horizon and applying it to now is pretty dangerous. And trying to apply any kind of overly complex copular structure to that, it's probably asking for trouble.
Hmm. There's a few more copulas I want to ask, just because I know I've seen them in exams, but I haven't heard you mention them. There's a Frank, Gumbel, and heavy right tail. Are those that you've used in the past?
Yeah, so Frank and Gumbel are both Archimedean copulars.
Oh,
so
they're both okay.
Yeah, they're both. So got the Frank copula, the Gumbel, and the Clayton are the most popular Archimedean copulars, which have that really nice, easy approach. And it really is. It's it's a real sort of sausage machine approach. It's lovely. You just take your inputs, chuck them through, crank the handle, add stuff together, crank the handle back the other way. You've got a probability. It's so much easier than doing something through, say, a 𝗘𝗏𝗧𝗏𝗧, unless you're doing it with R, of course. Those are very popular and very simple to use. So they're definitely worth considering. Was the final one sort of heavy tail, you say?
Heavy right tail, I think it's called.
Heavy right tail. Never use that one.
Okay.
I've tended to, in practice, if I'm using copulars, it tends to be either Gaussian or 𝗘𝗏𝗧𝗏𝗏. And it's largely driven by how much additional use you can get from additional complexity.
That's a really good point. Thanks for that reminder. Because actuaries love complexity, right?
Well, yeah, and I think that there's different reasons that people might be drawn towards complexity. One is, it's really nice to get what looks like a better answer by using stuff like copulars. But the cynic in me says it's also quite helpful from a marketing point of view. If you can go to your clients and say, look at this, this model here, which is modeled using a range of different marginal t distributions, all joined by a skew t copula, which gives us the best results. The chances are I get a pretty similar result if I was using a multivariate normal distribution in many cases. And that is, and I've seen that. I've reviewed other people's more complex models with a multivariate normal model. I've done the back of an envelope and come up with numbers that aren't a million miles away. And sometimes you do need really exact results. Sometimes, if you're trying to work out how much capital an insurance company needs to hold, you want to be exact on that, because that's going to make a big difference to the amount of capital that you can put to work for shareholders. So in those cases, it's really important. But if what you're really trying to do is just get a broad comparison on the risk-return trade-offs for different portfolios, do you really need to boil the ocean on that? If your hourly rate is high enough, you might need to, but I would suggest caution.
Good point. Driven by the use case. I fully agree with that assessment there. Now, in our previous conversation, you mentioned that there are two fundamental ways to build risk models using copulas. So what are those two ways? Sorry, did you hear my question?
Yeah, no, go for it.
Yeah, oh no. I don't remember what the two ways were. I think one way was like squaring, and then the second way, So the question was the two ways of building risk models.
Yeah, so I mean, if you're looking at kind of standardized approach, the way that you'd tend to do it would be you'd have a correlation matrix for all the different risks, and then you would just join everything with a correlation matrix. So, not quite square it, add it together and square root it, but only one step removed from that. And then the more complex approach is you stick it through a copula. And that could be an Archimedean copula, or it could be a Gaussian, or more broadly an elliptical copula is what you group together for either a Gaussian or 𝗘𝗏𝗧𝗏𝗏. So that is one way of doing it. I mean, and we got different ways of doing that as well. I mean, you've got you can just plug your numbers into essentially copular functions and get the answers out, or you actually simulate data. So you can simulate stuff out into the future, do projections, and then actually count the number of observations below a particular level. Now, that additional level of complexity, again, a lot of the time you won't need to do it. But if you've got cash flows going in and going out, then you probably do need to start looking at projections. So what you then need to do is you need to say, I've got these different asset classes. I think I know what their distribution is. I think I know what copula is linking them. What I'll do is I'll generate a whole load of distributions, a whole load of simulations based on the data that I've got. And then I'll project my assets forward. I'll have my cash flows in, cash flows out. And then I'll look at my end amount, my end asset value, and I'll essentially find out what my 10th centile is, my first centile, or whatever centile I need in terms of risk management. So that's another approach.
Mm-hmm. There's one in your videos on YouTube as well where you talked about using fitting copulas using the maximum likelihood estimator and then the method of moments. How does that kind of play into what you just said?
Yes, so some copulas you can fit using method of moments, which is essentially, if you're looking at something like an Archimedean copula, which is defined by a correlation coefficient, you can basically just say, okay, well, let's just look at the correlation coefficient. That's told me how my copula is fitted. And if you're doing a Gaussian copula as well, you could say, well, if I stretch all my data so that my marginal distributions are normal, I'll just calculate the correlation coefficient between them. That essentially tells me what the correlation matrix for my Gaussian copula should be. So that's a pretty useful and straightforward approach for fitting a copula. The disadvantage, or the key disadvantage with this, is it doesn't tell you how good that fit is. So you could do that for the same set of data for a bunch of Archimedean copulas and for a Gaussian copula, even for a T copula if you wanted. But it wouldn't tell you which of those are the best fit. Whereas if you do maximum likelihood estimation, that gives you a likelihood function in each case when you've found out what your maximum likelihood estimators are for the parameters. So then you can actually say, okay, which of these is the most likely form of copula for this particular scenario? Now, maximum likelihood is, if you try to do it on paper or you try to do it in Excel, it can be quite tricky. I mean, you've essentially got to have the copula density function, and then you have the copula density function with each of the observations, and you multiply them all together, or rather you log them and then you add them all together and you do some calculus, or you just get R to do it. I mean, R does it very well and very easily. It's even more difficult if you're not using R for the Archimedean copulas, and the reason for that is that, and I apologize, this is going down a bit of a rabbit hole and might not be of much interest to some people, but Archimedean copulas, one of the reasons they're so useful is that they are defined in terms of a distribution function or a copula function, okay, which is why it's so easy to plug stuff in, crank the handle and get the answer out. For a Gaussian copula or a T copula, as you remember from a normal distribution, what these are defined by is the density function. So if you want to find the probability from a normal distribution, there's no closed form solution to that. You've got to use tables or a function. Yeah. Mm-hmm. So if you're using a Gaussian copula or a T copula, the same is true. There's no closed form solution to that. So that means that it's a bit easier in terms of maximum likelihood because you've got the density function there. But what it means is if you're doing maximum likelihood for an Archimedean copula, because you start with a distribution function, you've got to turn that into a copula density function. And whilst the generator function is really easy, the density functions are really hard. Like they can run under 3 lines of function with 𝗣𝗵𝗂𝗹 function of the second kind, or there's stuff in there which I never come across anywhere else. So it's horribly complicated if you're not doing it through R. Fortunately, there are people who are far cleverer than me who've said it might be complicated, but I'll code it into an R function. So you can just take that and do it. But maximum likelihood versus method of moments might give you slightly different answers for the parameters in some cases. But the key advantage is you can run it across a whole range of different copulas, and you can say, okay, which of these is the best fit? And there's a range of tests that you can do then, but you can do things like look at fitting a T copula to some data or fitting a normal copula to some data. And you can say, I'd expect the T copula to give me a better fit because I've got one more degree of freedom that I'm using. But is that better fit better enough to justify this additional parameter? So using maximum likelihood gives you numbers that you can use in those kind of calculations to work out whether adding that additional level of complexity is worth it or not.
Okay, well, thanks for the clarification. Now, earlier on, you talked about the financial crisis, and I just wanted to kind of take a step back and maybe get a bit of clarity on this. So, I know you were talking about the different tranches. I think you were talking about, it sounded like you were talking about default risk. So,
Yes.
when we take a step back, just to understand, what I'm trying to understand is what exactly, the copulas were seeking to model originally, if it was default risk, contagion risk, and I imagine it was that you were talking about the credit default obligations, I think.
Yeah.
So like if you were just like in its most fundamental sense, like what were was it primarily default risk? Is it contagion or something else or a combination of?
Sure. So what they were trying to do was they were trying to model the relationship between default risk in a portfolio of bonds. So if you're a load of if you think about what some of these CDOs were, collateralized debt obligations is what they were. What they had was they had a whole portfolio of loans, say housing loans for different individuals. And each one of those will have its own particular risk of default. And the trick is, if you've got a whole portfolio of these, what is the link between these probabilities of default? And the way they modeled this was using something called a time to default model. So you had a parameter in here, which was essentially the hazard rate, kind of the risk of a mortgage essentially eventually defaulting. And you had this for all of the different loans in there. And you could link these times to default using copulars. And the person that wrote the paper on this showed what a neat model this was. And as a kind of use case, said, yeah, so if you took all this and you linked it all through a Gaussian copular, this is how you could measure the risk of the losses being in the portfolio being 1%, being 5%, and so on, using a Gaussian copular. And once you've done that, what that allows you to do is to set your attachment points. So the attachment point is the cutoff between different tranches. So you might have, say, a AAA tranche, which has a probability of any loss in the portfolio being very low indeed. So you'd need, almost everything to have gone bust in the portfolio before you start eating into that one. Then you've got, say, a AA portfolio and so on until you get to what's called the equity tranche. And the equity tranche takes the brunt of all the initial defaults. So if someone goes bust, the equity tranche gets hit. People with investments in the equity tranche make losses. People higher up the food chain don't. So if you're using a Gaussian copular, what that might mean is you are underestimating the risk of things jointly going wrong. You haven't got fat enough tails. And what that means is the attachment points that you've set for some of these higher quality tranches is in the wrong place. And the risk that these people are bearing is actually higher than they think it is. So, and that's what happened, is that you found that the number of high quality tranches of CDOs going bust was much higher than was anticipated by the models. And that's because the models were wrong. They're using too simplistic an approach. So it's a bit of a shame, because it was and is a really nice way of taking a bunch of securities and being able to slice it and dice it in such a way that people can get exposure to it, whatever their risk appetite, whether it's extremely high risk appetite, they want the equity tranche, or it's really low, they want the AAA tranche. But yeah, the use of the Gaussian copula in that modeling approach and various behavioral and incentive-based problems around the sale of those securities as well, and the underlyings as well, meant, unfortunately, things didn't turn out as people would have hoped.
So it sounds like there was some mistranching, the stuff that was riskier. So, there are some things that fell into lower risk tranches, which are relatively high.
Yeah, the reasons for it are manifold. There's a number of reasons why it went wrong. I mean, fundamentally, the risk of lots of mortgage holders going bust together was much higher than the models predicted. So you thought you had a secure investment with a super senior tranche, AAA tranche, and you didn't. Now, why did that happen? One reason is when things go wrong in the economy, they might affect everybody. They might affect an awful lot of people. There are also issues around the selling practices associated with some of these mortgages. So some of them were sold to people that were never really going to be able to pay them back, and they had features which meant it would be very difficult for people to pay them back. So that was problematic as well, and that kind of compounded the risk from the economics as well. So I mean, there have been books, there have been films on this which explain some of the underlying problems. I mean, if you've not read or seen The Big Short,
that's the one that came to my mind. Yeah,
it's a fantastic film. It really
great.
is.
It's funny.
Very, very entertaining and a very useful description of exactly what went wrong and why. But mathematically, what went wrong was the copula didn't have fast enough joint tails for a range of underlying reasons.
Yeah, the paper that I read, I remember kind of is essentially what you're saying. It's like it made assumptions on independence. It assumed that the risk of default among some of the different mortgages, I think, that they were independent, I think, or that there wasn't. Yeah, go ahead.
I'm not sure it was independent, but I think they put a single correlation coefficient, I believe, a single correlation coefficient across and the whole portfolio. Okay. But they assumed that there wouldn't be jointly fat tails. They assumed the Gaussian distribution. And, that is not the fault of the author of the paper, because, if you're going to do a kind of proof of concept on something like a time to default model, you'll say, okay, so show how it works, we're sticking a copula. What copula are we going to stick in? A Gaussian, because that's the one which involves the least choice, the least explicit choice of any kind of distribution. If in doubt, just assume it's normal. Now, when you're doing it in practice, then you might want to say, well, is it the best distribution to use? The best copula to use? And the answer is quite clearly, well, in retrospect, no. But for an academic paper on how this works, the Gaussian copula is absolutely the right thing to do, because you don't want to get bogged down into more complex types of copulas. But if you're doing it in practice, you probably want to use something a bit more complicated.
Yeah. Okay. So we've spoken quite a bit about copulas. There's one more item I want to touch on as it relates to ERM, which not necessarily, well, I guess it is related, but maybe not in a technical sense as much. But how do you describe corporate governance as something that's a really relevant topic as it relates to ERM? And so how do you describe corporate governance and its significance in enterprise risk management?
Sure. So I mean, corporate governance, what it really describes is the set of rules that you have in an organization as to how things are done, and how things should be done. And if you're looking in an enterprise risk management, and I kind of described a sort of control process at the start, but that has to sit within the particular internal and external environment that the organization is based. So the external environment is going to be stuff like, what are the laws of the country in which you're based? What are the regulations of the industry in which you're based? What external constraints are there, and similar factors that affect what an organization does. Then you've got the internal stuff, the internal context, the internal environment. And that is really where corporate governance comes into play, because it tells you the setup for the enterprise that you're looking at, and it tells you how the organization is run, the systems and processes and structures that it has in place. And those will have a big impact on the ability for risk to be properly managed. In terms of, do you have the right level of independence on the different bodies in an organization? Who's determining pay? Who's determining director remuneration? Who's determining promotions? Who's making all the big decisions? What controls do you have over people at different levels of the organization? All that kind of stuff. Corporate governance is really just telling you how the organization is run, what the rules are.
Mm-hmm. And are there any, and like I said, whatever you're comfortable sharing, are there any stories that you've seen where there's the past decade or two where you saw that, you know, whether it was a failure of corporate governance or just something relevant to corporate governance that you think might be worth noting?
I haven't seen too many bad examples of corporate governance, thankfully. And most of the stuff is around just kind of like small tweaks around corporate governance where you can make big improvements. I mean, I think one of the things that I've noticed around corporate governance is it's not enough to have the right governance structure. You can have the right governance structure in place, you know, the right rules, but people have got to stick to them. People have got to actually obey those rules. And for that to happen, you've got to have the right people in the right roles. Mm-hmm. So, and that's where corporate governance intersects with culture. And culture is really important in any organization. It's also quite difficult to change as well. And it's about having, as I say, the right people in the right roles who are able to effect that change and to make sure that whatever corporate governance structure you have in place, to make sure that it is stuck to. Because, you know, bad corporate governance is unhelpful in terms of structures. But good governance structures are only as good as the people that are operating within them. So it's really important to have the right people leading those types of organizations and making sure that the governance works, that you've got sufficient empowerment, that you've got sufficient accountability, and that you get the best out of whatever governance structure you put in place.
Good. I think that's a good positive note to end on, and it's been very insightful conversation as always, Paul. So I just want to thank you again for your time and looking forward to sharing with this with the community. I'm sure everyone's going to appreciate this interview.
That's great. Good speaking again.
All right. Have a good one, Paul. Take care.
Thanks.